can now move forward with Andra, who's going to be talking about valuations. What are some of the, let's say, standards now in the Baltics, or the, let's say, averages about that? Investment agreements.
Maybe let's do like a 5-minute break for everyone to stretch the
Do we
legs.
need a break?
We had one, like...
You sure? Okay.
Yeah.
Okay. Well, if you feel comfortable, then of course, happy to step in.
The clicker.
Yeah. Thanks so much. How much time do we have, just so that I'm aware?
We can push 45, 50 minutes.
Okay.
Yeah.
Okay. Okay. Nice. Very good. Super entertaining. Thank you so much. Like a lot of insight and very practical tips, and you definitely spoke the truth, which I appreciated. So make sure that you remember what was said. We'll dive into a topic that's a bit more technical right now and talk about legal limbo. Before that, just like a very short introduction. Myself, I'm a partner at First Pick. We're an early stage fund based in Lithuania covering the Baltics. I've been in the tech space for 10 years now. Started my career at Civita, so the slides I saw today definitely resonate. The first job that I did was making slides, so the consulting style slides are something that's still with me. But later I worked at Startup Wise Guys. Maybe you've heard the Estonian accelerator. This is where I started my career in BC. And in 2022, we launched First Pick, our own 20 million fund, as I said, to invest into Baltic tech founders. If you feel like reaching out or connecting, please make sure to do so. My email is there. And a couple of words on First Pick for those that haven't heard about us. We're a high-speed VC fund and an accelerator for tech startups in the Baltics. This is our team, 7 people with a bit of funk, but a lot of focus. We're managing 30 million in total with the fund that we have launched in 2019 together with Startup Wise Guys. The market value of portfolio companies is now around 400 million. We have backed more than 200 people, so quite a big community, and have done 5 exits to date. So we've been quite lucky with that, but also worked a lot on DPI in general. So this year we have actually launched our own DPI department. So we definitely implemented a lot of the things that you've heard earlier today, and we have mapped out the whole portfolio, and we very carefully think of how to exit, how to create liquidity for our LPs, because entering the positions is only half of the job, in my opinion. It's a much bigger job actually to think about how to exit, how to look for those opportunities, when to exit, when is enough, and when you maybe need to keep on pushing. So we have some experience with this for sure. Now, we are quite proud of this number. In 2025, we looked at 92% of all the deals happening in the Baltics. So we actually see pretty much every company that's fundraising. The 8% includes some growth rounds that we're not really looking into. And we have invested in 30% of all the companies that have raised money in last year. These are some of the companies that we have backed with the 2022 fund. A couple of Latvian companies that maybe you've heard about. Handwave, one of the bigger investments that we have participated in this year. Also Swatsea, Theo Growth, maybe you saw them somewhere in the news. But of course, the portfolio is quite dispersed between the Baltic states, with Lithuania now taking the majority, mostly due to tailwinds in the market and in general, a lot of good Lithuanian companies that exist. And our LPs include really a great bunch of founders and fund of funds. So we have been backed by the founders of Lithuanian unicorns, Tesonet, NordVPN, Vinted. We have a couple of really cool fund of funds like Speed Invest or Gus Capital that have backed us. So it's a good bunch, a good crowd of people that not only invested us, but also provide support for our portfolio companies. So just a little small overview so that you know where I come from and where the things that I will be talking about today are coming from as well. And again, if you have some questions, feel free to jump in. Let's not wait for the end. Let's try to make this interactive because it's quite a technical topic that I'll have to cover today. So I don't want to bore you. And if we feel like it's something that you already know, because I'm not sure about the general level in the room, so feel free to interrupt. But before we dive in, I wanted to do something entertaining and to share the numbers on what's happening in the Baltics. So every year we collect data directly from the founders on the rounds that they have raised, the valuations, and then we compile this Baltic Startup Funding Report, which we share to the public because we think it's a good resource to have, and it's nice for us to remember the consulting times. Because 3 of the partners actually worked in Civita before, so we've been consultants. So let's look at the numbers. I talked about this. The only thing to note is that everything's going to be in euros, and the date range covers the first half of the year, so everything up until the end of June. So if we look at funding in the Baltics, it reflects the same dynamic that has happened everywhere across the world. In Europe, in the US, we had a big peak in 2021 and 2022, which was also largely inflated by the growth rounds that happened, and in particular by the massive round that Bolt has raised. But in general, the numbers have stabilized after this market growth. And at the moment, we are seeing quite consistent numbers, which are higher than what things were before COVID and before this market peak in 2021 and 2022. So the first half of this year actually is showing quite positive signs. And startups in the Baltics have raised more than they have since the beginning of 2023. But of course, majority of the growth comes from growth rounds, so everything that's Series A+. So every time you see, in the news, one of the unicorns or in general a larger startup raising money, this is gonna basically inflate the numbers and drive the numbers up. In general, if we look at the number of rounds, they have been quite stable. We haven't really seen a big variation, which tells us that although the euro value is fluctuating from year to year, the number of rounds themselves, they're quite stable. It might look like the number of rounds is decreasing, but if we looked at the dollar value, actually, it's increasing. So that means that companies are raising more money and companies are getting more expensive.
The dollars, or what's the metrics?
This is the number of rounds. The number of rounds between different categories. So basically 72 investment rounds happened in the Baltics in the first half of 2025. Yeah. And this is exactly the reality. Companies are raising more money, and you can guess that the valuations are therefore increasing as well, right? So if in 2020, like an average pre-seed round, probably something that you as angels would normally look at was around 100K, 130K. Today, it has increased to 500,000. So it's a big 4x increase that we're seeing in the market. And so naturally, you as angels, if you want to invest and participate, you need to be aware that the amount of equity you can get for the 5, 20, 50K that you want to invest will be lower today than it was in 2020. So naturally, you probably also want to increase your ticket sizes to have any meaningful stake in the companies. Pre-seed has also increased, as did Series A, but the jump there is not as big as it is in pre-seed.
What's the reason behind?
In general, this market has been trying to catch up with what's happening in the Nordics, what's happening in the West. So naturally, as the market is becoming more globalized, founders have better access to VCs outside of the Baltics. They want to raise more money. So that's one thing, right? We are getting into kind of on par with what's happening in the Nordics at least. And at the same time, it's becoming more expensive to reach the same results than it was in 2020. So salaries are increasing, you need more resources, it's getting, like the job market is very competitive. To get good talent, you need more money. And also companies, in general, it's much more difficult to raise than it was in 2021, for example. So founders want to make sure that they have enough runway and enough money, in essence, to be able to reach the next significant milestone to raise capital. So when you combine all of these factors, it ends up, inflating the rounds slightly. But still, if you would look at what's happening in like Sweden, Denmark, the average pre-seed round there is 1.5 million. So it's closer to what a seed round is here.
Middle East is like 1.5.
Yeah, exactly. So we still have, you can expect the startups to raise even more money in the future, actually.
Like 130 is like seems very very low.
Yeah, it's nothing.
Nothing.
It's nothing, exactly. Yeah. Like what could you do with that?
Even
today?
like $500,000 is surprising to me. I would expect that number to be at least $1 million.
Yeah.
Right.
Given where the ambition, expectation, salary, exactly as you mentioned, like resource pricing is, like the pre-seed to the next typically should be 18 to 24 months. You have one way of 24 months. Like the team of, I don't know, 15, like you need more money.
You
Yeah.
burn something like 50K
Yeah,
a month.
I think for 500, definitely you don't have like 24 months of runway. It's less. It's a year and a half maximum. More like 12 months,
it's
maybe
going to be
even.
hard for them to reach the next milestone.
Exactly. So yeah, the best founders today, their first round is like 2-3 million. Like creme de la creme founders that everyone is fighting for. That you have like the London funds flying in. This is what they raise. So.
All these previous 2020 pre-seed 132 remind me of these scamish peer-to-peer lending schemes we used to have in the world.
Yeah.
And then, well, the business idea was not essential. It was just
Well-
getting the funds and then fleeing.
When we started in 2019, we actually like.
Then the rings the bell.
Yeah. When we started in 2019, we have done like 30, 50K investments. So I believe it. And some of the companies are still alive and growing today. So, it was possible. Very humble, very scrappy founders.
Okay, can
for
you
sure.
say like for 540 average round, so let's say that's assumes like $500,000 for rounding error sakes, what do you see as the pre-money valuation cap? Like 3.54 million?
Yeah.
Mhm.
On average, yes. So that has also increased significantly. Like it used to be more million and a half. Today it's more like 3-4 million pre-money. That doesn't surprise us anymore if the founders come with that.
And those who raised 3 million, those cream founders.
More than 10.
It's 12, yeah. I mean, like in general, the first round at pre-seed, the founders don't want to give away more than 10, like 15% of equity maximum. So you can always do the backwards calculation on this.
It also becomes uninvestable if you give up more.
Exactly, yeah, because the founders then don't have enough equity at Series A, so like you mess up the cap table, etc. But in general, as a region, Baltics really stand out. So if we look at VC investments in the Central Eastern Europe per capita, Estonia, of course, is the leader there for sure, but Lithuania is catching up. Latvia is somewhere in the middle, but still above CE average. So actually, it looks like there's quite a lot of capital in the market for the population size that we have, indicating that there is a lot of investor interest. And for you, that's good, because as angel investors, you want to make sure that there are people investing in further rounds, right? So that you actually have opportunities to exit and for the company to grow.
This is actually very interesting. Can I make one quick comment on this one?
Sure.
The big correlation what you can see here is between how many local pension funds are actually providing capital to the VC funds and how much local development institutions supporting the funds. Estonia and Lithuania, with their development financial institutions and selected pension funds, is leading the way. Croatia has now reformed their pension system, and they have one pension system founder who invests, let's say, the system allows 15% of the money to be dedicated into the private market space. That's a massive change in the pension legislation in the CE countries. Poland has prohibited to invest pension funds in the private markets, right? And sort of Romania and Bulgaria now are applying to OECD, and OECD's requirement is to have 5% of the pension money to invest in private markets, and they right now have 1. So you're going to see that big jump in Romania and Bulgaria because of the OECD acceptance, right? And I think that's going to be the time where Bulgaria and Romania will go over Latvia. Right? And I think that is going to be something which we should be aware of, and we should not actually allow it to happen. Because Ukraine, of course, is a different story because of the war, but essentially Poland is last because of the very aggressive inflation, and now Bulgaria and Romania will go over Latvia. So I would be as a Latvian, like I need to do something, not to be on the bottom of the page.
Yeah, that's true.
What's the difference then from this pension type of legislation between Lithuania, say, and Latvia right now? So
I guess it's not really different. I guess Estonia, Lithuania is leading just because they have unicorns and founders who really felt passionate to reinvest in other kind of founders.
Yeah, the mafia effect.
The pension systems, Estonia, Lithuania, and Latvia are very much the same.
It's more like founder based.
Yeah, of course, this includes all VC investments, so not necessarily only the local investors investing in the market, right? So, of course, like that contributes in general. What's the setup of the existing VC like an investor space, but this also includes external capital flowing in. So of course it's inflated mostly by very, very big rounds happening. That's true. So like Bolt, etc. Because this is where the major upside is happening. If we look in general what's happening across the Baltics, it's interesting to see that Lithuania and Latvia see quite good growth, whereas in Estonia we see a little bit of a slowdown. So this is 2024 total numbers, and this is only the first half of 2025. So we see that Lithuania has already raised more money this year than they did last year, and the same for Latvia, whereas Estonia really is not keeping the same pace. So it looks like... Yeah. So, well, yes, true, but I mean, it's not easy, right, to grow from this. So what we're seeing is a bit of a slowdown in Estonia, and we see that in terms of pipeline as well. Multiple reasons for that, everything from like economic situation in general to the fact that maybe everyone that wanted to try and become an entrepreneur already did, population size. Hard to tell, multiple reasons, but at least this year, this is what we're seeing. Of course, it's not, then the year hasn't ended yet, so we'll still see the final numbers coming in, but at least the tendency is here.
Even by lack of funding or by lack of good enterprise to invest in.
That's always a chicken and egg problem, In terms of Lithuania, we're seeing growth in terms of all stages. So you can see that there was quite a heavy growth in terms of seed funding, which used to be quite stable. Series A funding is highest than it was since 2022. And then growth rounds, again, these are fluctuating a lot, but we see good growth across all different stages, which is quite a positive sign for the ecosystem in general. Now, if we look at Baltics in general again, and what has happened here, probably you know very well that we have produced 14 unicorns across all 3 Baltic states, and the combined enterprise value has grown also faster than CE average. So especially in Lithuania and Latvia, which is interesting, Estonia has grown, but not as fast. So we are quite proud, and you can also be proud of this number, show it to everyone and say that it's only the beginning for Latvia. But of course, when we look at the numbers in general, majority of the growth, as I said, is coming from top-heavy investment rounds. So if we look at the top 5 rounds across all 3 Baltic states in 2025 and 2024 and 2025, in some cases, the dynamics are similar. The growth rounds are driving the majority of total funding, and it's increasing proportionately. So whereas in 2024, we had around half of all the money going into growth stage companies, this year it's actually even more. So that is a good sign, it's a healthy sign that the ecosystem is growing, but at the same time, we need to make sure that we provide enough capital at pre-seed stage, right, to grow the pipeline, to make sure that we have enough good opportunities in the future. What's also interesting is that despite the AI wave, the median round sizes stay quite similar. Everyone is expecting, the round sizes to grow up because of AI. We say that AI is inflated, etc. But if we look at the median round sizes by vertical, actually, fintech, health tech, defense tech, and AI are quite similar.
This is at what stage?
This is mostly for seed. Yeah. well, we included everything in the like everything up until growth in the data, but wanted to check what are the median, so the most frequently recurring numbers. And if we look at the biggest rounds that have happened this year already, you can also see that like fintech, health tech companies, defense tech companies, they are the ones raising quite big rounds. AI, well, this CAST round was just massive. Irons, this was what drove the Latvian numbers up quite significantly. Stargate Hydrogen, yeah. But these are the largest 6 rounds that happened in the first half of the year. We already looked at the total numbers, but it's important to note that foreign investor interest in the Baltics has grown dramatically. If in 2020 it was around 25% of all the money flowing in, meaning that the growth of the startups was mostly financed by existing investors, today, half of the capital coming into the market is coming from external investors. So 2 things. Of course, they are the ones investing into growth rounds because we don't really have growth capital here in the Baltics for startups. We only have 1 Series A fund, Karma in Estonia, but they have a European mandate. So even them, they do only a couple of deals in the Baltics. So everything Series A up actually comes from foreign investors. But more and more, we are seeing foreign investors coming in at earlier rounds today. So they do seed deals, they do pre-seed deals. Finally, we have done enough PR for the Baltic ecosystem, and they see that there is good potential here, that there are good founders, and they want to invest, and they want to be leading the first rounds as well. So this really hasn't happened.
What are these investors? Are they, I don't know, institutional funds, family offices, private individuals? What is it like?
It's mostly VC funds. So a lot of VC funds from Poland, like Balnord, Innovo, OTB, funds from the Nordics as well, by founders in venture, Creandum, EQT, they're looking into deals. Also, London-based funds, really like a bit of everything, to be honest. And we have also now participated in at least like 2 pre-seed deals that were led by a London-based VC in Lithuania, preempted before everyone else. So, it's getting really competitive, which means that it's getting more difficult for local VCs to get access to top deals because they have to compete against guys with bigger pockets. And it also means that for you as angels, it's getting more competitive. So if you want to be in the top companies, you really need to build a very good network, be proactive, have your ears all out to make sure that you don't miss out on the biggest opportunities, because those deals, they get signed before anyone hears about them in the market.
But that's mostly concerns growth financing, right?
Not necessarily. So we have now joined this one deal in Lithuania, company built by an ex-founder, and it was preempted by a London-based VC. The partner is Lithuanian. He has a VC fund in London. He did the round. Everyone else in the market didn't even have a chance to look at it. So these deals are happening, and that's why you as an angel, you have to make the decision if you like the company super fast sometimes. And that's why it also makes sense to tag along to other VC funds, for example. So yeah, some of the tier 1 funds that have invested in the Baltics this year. So tier 1 funds are like top of the top, creme de la creme, the best funds in the world. Index, Balderton, Early Bird have done deals in the Baltics this year. And that's good for everyone because it puts Baltics on the map. There's a lot of press coverage typically on these deals, and that helps our ecosystem to grow. What's great to see is that local funds actually participated in 84% of the deals, so almost everything, which means that if you invest in a VC fund, most likely you have very good coverage of the market because they're still in those deals. The 16% most likely are the growth sides rounds where local pre-seed seed funds no longer participate. And if we look at the funds in the Baltics that are currently investing, throughout them, there's about 1 billion dry powder. So quite a lot of capital that's here to be invested in the Baltic ecosystem. You can see we're very happy to see the new funds in Latvia launching this year, Outlast and Bad Ideas. I think that's going to be a very positive change for the market, providing capital for the early stage companies to make sure that, you just need to finance the market to get it going.
And these are all Baltic funds?
Plug and play.
These are all Baltic funds. I mean, like Plug and Play, it's a franchise, but they have a fund in Lithuania managed by a Lithuanian team now. So they have franchised the brand. But all the others, yes, these are Baltic funds. Right. And what's driving the ecosystem today are hacker houses, which is very interesting. Like we thought that hackathons are dead, and then somehow last year there was like a big revival of hackathons, and these hacker houses where Gen Z guys are sitting and trying to build the next unicorn. So this is really refreshing to see this new energy in the market. I think it was missing for a while. And if we looked at like the hackathons that happened last year, so 700 people participated in them, 130 teams were formed, and 4 got funding. So it's a revival of this, like, trying to build something new, of course, enabled by AI, enabled by vibe coding. You can have your opinion on it if you like it or if you don't. But definitely a shift is coming, and this new generation, these are the people that are creating the future. So, the 20-year-olds, they will be the ones they will be the driving force of the economy pretty soon. So we need to pay attention to them and listen what they need. Right. So I think that's it on the numbers. And now I wanted to do this small quiz to maybe bring some life to the room. So we'll play a small Kahoot because I want to understand how much do you know about the legal limbo, so that we can spend maybe more or less time on some specific topics. Yeah, we don't have the exit analysis, but I promise that you'll see that in January. We are cooking the report for 2025 right now, and we want to include data on all exits that happened in the Baltics and exits that happened in 2025. So you can expect to see them there. It will not be like a lot of companies that have been exited, but quite a few. Okay.
Wait, this is not the correct one.
I think worth mentioning in Latvia there's like startup school.
Yes.
Producing also additional, I don't know, maybe a couple of teams.
Yeah, for sure. I think it's a great initiative. We have a lot of very good talent in the market. A lot of good engineers, a lot of people that would want to start a company, but maybe they're a little bit afraid, they don't know where to start. So those initiatives, they are a great driving force for people to have, community support, knowledge to actually start building something on their own. So Startup School is a good example. There's also the intelligence space now. I think it's also a good community of founders. Okay, I think we need to close that.
Pop-ups.
All right.
And library.
Very soon we'll get to the quiz. Amazing. Let's host it. Nice. Okay, so you need to get your phones out. We'll do something, a little bit. We'll do a little bit of playing. So in a second, you'll see the game pin. So you can either scan the QR code over there or go to kahoot.it and then punch in the game pin. It's going to be a very short quiz, I promise. So make sure that you join and play and test your knowledge. Nice. We have a cat. We have several ones. Nice. I think these are like Halloween style faces,
Special
no?
ones.
Some of them at least. Like this one for sure.
Is everyone
Okay.
joined in? All right.
Yeah? Okay.
All right, starting.
You know how it works, yeah? You've played it before. Okay, good. Just wanted to check. Okay, so let's do it. First question about term sheets. What's the purpose of a term sheet? Legally binds both parties to complete the deal, non-binding document that outlines key commercial and legal terms, serves as the company's financial statement, or transfers ownership of shares. What is a term sheet?
So the winner gets 15,000.
Nice, very good. Yes, it is a non-binding document that outlines the key terms. Non-binding was the key word that you had to look for. Okay, which clause determines how proceeds are distributed in an exit event? Liquidation preference, pro rata rights, vesting clause, drag-along clause.
Oi, sorry.
Oh, what happened? Oh no, well, congratulations to this one person that answered.
Apologies for that.
Yeah, it was liquidation preference. Well, okay. What is the main purpose of a shareholders agreement? Rights and obligations of all shareholders, approves annual financial statements, determines the CEO's salary, defines how company profits are taxed. All right, well, this one was easy, you know. This one was easy, but I'm happy that you got it. Why include vesting for founders? Guarantees founders keep all shares, ensures founders earn shares over time and stay committed, increases company valuation, dilutes investor ownership. Nice. So you know everything. We can go to dinner. That's great. Okay, investor. If an investor has pro rata rights, what can they do? Force a sale of the company, buy more shares at a discounted price, maintain their ownership percentage in future rounds, or sell shares before others. Yes, the correct answer is maintain their ownership percentage in future rounds. So you have the right to invest more money to keep your equity stake. Very good. What does a drag-along clause allow? Now you will wish that you had that 10-second reminder earlier today, right? Okay, 4 options. Minority shareholders to force a sale, majority shareholders to compel minorities to join a sale, investors to prevent a company sale, founders to sell independently. Yes. Majority shareholders compel minorities to join, so that was the right answer. What does pre-money valuation refer to? I think this one is easy. I think it's too easy of a quiz. I should have made it
so.
more difficult. Yeah, I wasn't sure.
Well, we'll see in a second.
We'll see.
It was in the first lesson.
Ooh. We have more time. Yes, valuation before new capital is added. Very good. Okay, 1x liquidation preference. What does it mean? For options. Which one can it be? Right, okay, we'll spend some time on this then for sure. Yeah, it's when the investor gets back 1x of the money that they have invested.
That's not right.
Right.
For 1x?
Yes. 1x liquidation preference means you get 1x and then
The question?
you get everything according to your shareholding.
That's 1x participating.
1x, but yeah, exactly. Liquidation preference is participating, not participating.
Yes. Yeah. Yeah, well, okay, well, it could have been clarified. You're right. You're right.
Well,
What do you think about liquidation preference participating?
I slept this one.
Well, now I think a lot of the typical clause that we see in the market is 1x non-participating. So you get either the 1x or the percentage of your ownership in the deal, but not both.
Again, like if I would put liquidation profits in the agreement, then my expectation is I get 1x my money back, and then I participate in the proceeds. Like I don't see a reason like why I should put 1x on participating. But again, like if the market standard, that's
Like people are saying that it's kind of double dipping because you do both. So they say it's either or. Which one is the higher? At least lately. Okay. Final question on founder friendliness. Okay. Nice. Good. I lost track a little bit. So who is the smartest on legal things in the room? Or at least who answered the fastest? It's JB, then Ugis, and PM. Congratulations. Whoever it was, congratulations. Okay, very good. Thanks for joining in. I see that we could have made it a bit more difficult. I wasn't sure what's the overall level in the room. And now we have like 20-ish minutes, right? I think for the rest.
Yeah, roughly, a little bit
Okay,
less.
very good. But since you know everything, we'll do things quickly and stop me when you feel like you want to dive deeper. Let's start with term sheets. So how the typical investment process looks like. From pitching to money in the bank account, we have a couple of steps. Signing the term sheet, the non-binding agreement outlining the contract, the commercial details of the deal, the commercial and legal details. Then, of course, legal due diligence happens, investment agreement, and if it's an equity deal, then you have the shareholders agreement right away, share subscription agreement, and only then the founder gets money in the bank account. If it's a convertible note, you would skip the share subscription agreement and shareholders agreement until you convert into equity. Now, the term sheet itself, as you answered very well, is a non-binding agreement, so I think that's very important. Basically, you express your interest to invest in the company at certain commercial terms, and if the founder agrees, they sign the term sheet, and then you proceed with actually negotiating the whole contract, right? So this is, I think it's key to understand that it's non-binding and both parties can step back after signing the term sheet. That doesn't happen very often, but it has happened in some cases in the past.
NDA is signed before the term sheet typically?
Honestly, we don't see NDAs being signed in as much in VC deals. I think like in private equity that happens, or in growth rounds that also happens as well. In pre-seed seed, normally you wouldn't sign an NDA, and everything is based on this like gentleman's agreement that you keep full confidentiality as an investor of the materials that you see. In some cases where maybe it's like, you know, some extremely sensitive information, the founder might ask for an NDA, but if it's a like generalistic B2B SaaS company at pre-seed stage, honestly, there's nothing to sign an NDA about because like there's so little IP generated.
The term sheet here is like few pages, or is it like 20, 30?
one page.
One page.
One page.
It can be one page, it can be a couple of pages, it depends on how extensive it is and how many terms are already included.
The very, very basics.
It's very basic.
I've seen like term sheet on 15 pages.
Well, I have
Come
seen
first
20 and
from the
30
British.
pages.
It
Therefore,
can
one page is kind
happen.
of,
Like why? Why would
just write the figure and that's it.
No, but this is like why would you write 15 pages?
I think the main reason for that would be to include the key terms that you want to make sure the founders agree on before moving into the investment agreement. So for example, things like liquidation preference or drag-along, tag-along rights, or founder vesting, right? Because you want to make sure that you can just postpone this negotiation and then have it when you discuss the investment agreement, or you include those terms in the term sheet and then you have negotiations at the term sheet stage. So it depends, right? You can do both, and funds choose different methods that they
I think in the market you also have probably like over legalization of these things because all the funds have EIF investment, and EIF investment legal teams have specific things they want to ensure. So therefore, like none of the funds who are like commercially thinking would put anything more than 1 or 2 pages. But if they have an obligation, set an LPA agreement, which typically is set by EIF, then they would put all these things already in the first thing.
That would be my expectation or explanation. Because no one who commercially thinks would put more one or two pages together. Well,
Yeah, you put in the key information over there. So what you will see on the term sheet will depend on the type of agreement that will be signed. For equity investment, the key information that you need to see is, of course, the total round size, valuation, the equity stake that you will have as an investor. In a convertible note agreement, you have slightly more commercial details because it's a loan, right? So you need to have very good understanding of what's going to be the valuation cap, the maximum valuation at which your investment will convert, what will be the discount, what will be the interest rate, if any. These days we see it again in agreements, and when the loan needs to convert, and what's the qualified financing. Like if a company raises, let's say, $1 million, then your loan converts. So although it looks like there are more things that need to be included, convertible loan agreements in general are easier, they cost less money, and they are faster to execute and faster for the founders to get money in the bank account. Now, just to make sure that you know the main terms, I think you do. Investment is investor's contribution, right? Valuation, we have pre-money and post-money, basically before the money comes in, and then you just add it up. Equity stake is your ownership percentage. With convertible loan, the key terms are investment, again, valuation cap. So this is just the highest valuation at which your investment will convert. For example, if you put it at 5 million and the company raises the next round at 10 million, you will still convert at 5 million. So you put like a maximum cap at which you will convert. And the discount is a reduction of the share price upon conversion. Normally, you will have one or the other. It's very rare to have both, which means that if there is a valuation cap that the company reaches at the next round of funding, the discount will not be applied. So you don't do like this double dipping again, right? So it's typically either or. In some cases, it can be both. Other key terms that are included, of course, it's the interest rate, sorry, that's a mistake. Now we see 6 to 8% typically, and this means that you will have more shares converted at the valuation date. Okay, sorry about that, some mistakes over here. It's not the investment date, it's the maturity date. Typically that's 12 to 24 months. And qualified financing, this is the size of the investment that will trigger your conversion in case the maturity date hasn't arrived yet. So let's say 6 months in, the company raises 2 million, your qualified financing was 1 million, then you automatically need to convert. Some protective provisions that you see in investment agreements, of course, are liquidation preference, and this basically means the payout order. If there is a liquidity event, who gets paid first and what amounts do they get paid in. Sorry to tell you, but angels typically get paid back the last. So you are almost in the same bucket as the founders are. And that's why you need to be on good terms with the founders to make sure that they actually fight for good exit proceeds for you. You have anti-dilution rights, which means protection against future dilution in case of down rounds. In case the company is doing good and they are raising more money, dilution in terms of equity ownership is inevitable. So that will happen one way or another. And board composition, investors' board seats. Very rarely do we see angels taking board positions unless they provide a lot of value to the founders and the company. So maybe they have worked in the industry before, maybe they have a very good network, maybe they built similar companies before, then they join in boards, because normally actually it's a lot of work. Not everyone wants to be in boards and spend 5 hours each quarter at least preparing for the board meetings and making sure they help the company. And also in some jurisdictions you have legal liability if you're in the board. I think in Latvia, for example, you do. So if I was an angel, I would probably prefer not to sit in a board, even though you would be insured by the company, but still you carry this liability, right? And we had cases where I think it played out not very nicely. In agreements, we also see founder commitment related clauses, and this is vesting schedules. So you answered on that very well in the quiz. I'm not going to go deeper into that. And also transfer restrictions, which means limits on founders selling their shares. You don't want to invest in a company where the founder sells 20% of their shares next year, right? So it's important for you that they actually have vesting so that they don't have all the shares right away, and then to make sure that they don't have the possibility to sell very early without your permission, right? So if they're doing super well, if they raise a, I don't know, 100 million round in 3 years, maybe you agree to them like selling some of their shares and having some liquidity, but they need your permission to do that in essence. So what does it look like? So this is like actually our term sheet example. It's quite lengthy because we want to make sure that the founders understand what will be the key terms included in the final investment agreement. In the US, they would shoot us for this term sheet. You know, they would say, "Who are you, idiots?" 1 page is enough. But we like that, and we think it provides a lot of clarity right away. But basically, it's just a document outlining the key terms, right? So nothing too special about the term sheet. I'm sure that some of you already seen them and you know what they're like. Okay, so you signed the term sheet. What's next? Legal due diligence. At least some basic legal due diligence typically happens. So, you know, you check that the company is incorporated, that the shareholders are the ones that the founders told you they are. That's, I don't know, maybe founders don't have like some litigation or something like that ongoing. So it can be very basic, or it can be much more extensive where lawyers are hired to do LDD for like, I don't know, 10K and checking all the company's documents, etc. So at the early stage, typically there's very little legal due diligence happening. As the rounds progress, more and more legal due diligence is typically happening, and it takes longer. But in parallel to that, usually you are negotiating and signing the agreement, and this is typically the stage that's taking the longest. It can take anywhere from a couple of weeks to a couple of months, depending on how much the founders want to negotiate and how much you want to push back. So let's look at the investment agreements. Most typical and easiest agreement to sign, at least in the Baltics at the early stage, is convertible note. Convertible note in principle means that you are lending the company money for a certain period of time for a certain price. Normally, you don't expect them to pay it back, but you expect to convert it into equity. The next agreement that is also used in early stage is SAFE. We don't see it as much in the Baltics because it's not really adapted to the local jurisdiction, so it's a bit tricky. This is what you normally see in the US for almost any early stage round. It gives founders a lot of flexibility because just like with convertible note, they can sign separate agreements with separate investors. So for example, you're raising $500,000, you can have 5 people signing the agreements. It makes sure you have liquidity faster and you don't need everyone to chip in at the same time. The difference between convertible note and SAFE is more or less related to legal terms. Because with SAFE, you have an agreement for future equity and there is no debt in terms of accounting practice, whereas with convertible note, you do have debt on the balance sheet. And this is the major difference. And then, of course, the equity investment agreement, the one where you actually receive the shares and become a legal shareholder in the company. You directly purchase the shares for your investment. Typically, I would say it makes more sense to do it at slightly later stage, so at least at seed stage. But we see it in early stage deals as well. So it really depends. It's not worse to become an equity shareholder, at least in the Baltics. I'm not sure about other jurisdictions at the early stage. It's just that it takes a bit longer because you need to negotiate not only the investment agreement, but also the shareholders agreement to register all the shareholders, and only then the company gets the money in the bank account.
Company gets the money in the bank account, so it's not like a founder can sell some of their shares to some other party. Typically,
no. Typically, they have restrictions on ability to sell shares. And usually, like, okay, I understood the question now. Usually, the company issues new shares that the investors then acquire. So it's not the founders selling a part of their shares, but it's the company issuing new shares. At least that's the common practice.
And with the convertible loans, there's no discussion about shareholder agreements.
Usually, no. Usually, no. So what you're doing?
No, where would you convert into at some stage?
Exactly, and that's the tricky part, because then you postpone the negotiations on the shareholder agreement, and you as an investor, you put the founders in a power position because you have already invested the money, right? So when you are negotiating from an investor's point of view, before the transaction has happened, you have more leverage. You can push the founder slightly more. Whereas in convertible loan case, you have already invested, you already have the money, so they have more leverage in negotiations because, the money is already there. But
So there is no practice like, you can pre-agree the shareholders agreement that
you can do that.
put in place once.
You can do that.
Is it a common practice or not so much?
It depends. It really depends on the fund that's doing it, on you, on the founders. For example, we try to do it. We try to pre-negotiate so that we don't run into misunderstandings later on. It's typically attached as an annex to the investment agreement, and then we say, okay, these are the clauses we have agreed upon. Not all of them are active because we're not shareholders yet, but once we will convert, they will become active. If the company is doing well, then most likely you will convert at the next round of funding, where a bigger investor will come in and they will negotiate the shareholders agreement. So you will not have to do it. But if the company is not doing so well and they are not raising a next round, and you convert, for example, at maturity date, then you run into this problem that you need to have the shareholders agreement pre-agreed, more or less. Yes?
In how many cases do you actually see the ability to ask for the money back, rather for it to be a loan?
So for example, founders decide that this is not working out and they give back the money. We have seen this. It's rare, but sometimes it happens. The company is doing extremely well, and the founders decide to give back the money to the investors.
But they basically buy out other investors.
They buy you out, yeah. Very rare. But for example, Omnisend, maybe you know this Lithuanian company. Omnisend, it's a marketing automation tool, was one of the fastest companies according to Forbes in terms of growth in Europe. So they have raised an angel round very early on, and then they decided to give the money back to the angels because the company was doing well, and to basically keep all the ownership of the company.
But I thought more of a question in the agreement, in the loan agreement,
Mm-hmm.
the chance to ask for the money back if the qualified financing doesn't happen.
Well, there's not really a chance, I think. Like, what you can agree upon is that with the consent of investors' majority and founders' majority, the money can be paid back. If the company is doing well, if they have cash, if everyone thinks that's the best course of action, which almost never happens because you want to convert into shares and then your equity to grow.
So the loans you sign don't actually have an opportunity for you to ask for the money back if there's no qualified financing.
Well, not really, no.
So you either convert, well, you have converted some stage. You could never
Essentially,
ask
yes.
for the money
Or
back.
you write it off if the company is not doing well. You either convert or you write it off. Yeah, but like you asking for the money back from the founders, that's not really happening. We call it a convertible loan because this is what their jurisdiction demands. According to jurisdiction in the Baltics, you cannot just give money without writing it down somehow in terms of accounting, right? So it's a requirement, and that's why it's called like a loan. But in essence, like you wouldn't expect the founders to pay you back, and probably you want to convert into equity because that's...
But I think that what point Pavel is making is it's so you technically have a so you as a founder have a liability against the CLA provider. if the majority day comes, there are like actually three options. Number one is you convert. Number two is you delay the conversion, if you can be mutually agreed. Number three, like let's say the provider of convertible loan says like, I want my money back. He has the right to do that, and then technically what can happen is he can actually start the liquidation process. That's his right under the CLA.
Yeah.
So you can actually force a liquidation thing, and if you think there are certain things you can get back, if there's any value of that, like you would be in like not necessarily well seen in the community, whatever, like you have the right to kind of at least have some sort of leverage against the founder to say like, I have technically the majority date has come, like I have the right to basically demand the help and everything else.
Theoretically, yes. What we see is that founders push not to have this clause in the investment agreement because they think it's unfair, you're investing, right? Or if you demand to keep it, then they put in that founders' majority should agree on the payback. So it's both investor and founders' consent then.
But tax-wise, is it more preferential to have that convertible loan?
Yeah.
Because you can write then off not only the amount but also the interest rate.
But you run into the problem. If you run down, let's say $1 million convertible loan agreement, if you can write it off, you have to pay UAN on $1 million. So then you own the country 25,000.
That was what I was trying to understand. Because
Like,
the other option would be that you accrue interest, and then if you have profits on the other side, then you can set off against.
But the problem is like if you don't, right? Like what you do. So then the problem is you convert into equity, then you become an equity holder in a company which perhaps has a liability. And then you also equally, as an owner, share liabilities as the equity shareholder.
I really cannot comment on the tax situation in Latvia, so I don't want to give you bad advice.
How does it look in Lithuania?
For angels, I think like they definitely don't have any liability as shareholders inside the company. So typically they have preferred shares, which limits their liability to what has been invested, and like they don't participate, in case there's a bankruptcy or anything like that. In terms of the convertible loan,
Yeah, converting in preferred.
yes.
If they're converting preferred, if you can convert in common, that's also a very important part. You're converting into the preferred shares. If you convert in common shares, then you have a liability.
I think in Lithuania you don't.
You have two class
Like-
share system, okay?
Like with preferred shares, you definitely don't. But I think, I'm not a tax expert, so I really don't want to give bad advice. And I would prefer not to say something I'm not 100% sure. Speak the truth. Exactly, speak the truth.
4-ish minutes.
Okay, yeah, let's go. Oh, okay, we're over time already. Nice. So we'll go through that. I think you can compare when it works, when it doesn't. They'll have the slides.
You'll have
right?
the slides, yeah.
Okay, what comes with the investment agreement? So a couple of things. Like I said, the shareholders agreement, right, which basically outlines the responsibilities and basically all the rule books of the shareholders in the company. Includes the crucial clauses, the control and voting power, and the actionable advice is actually to read it. So very, very simple. Also, the share purchase agreement, which typically is a very technical document, it just outlines the exact amount that you're investing in a company, the exact amount of shares that you're receiving. So you need to double check it, but it's not a lengthy document. Now let's very briefly look at the key clauses. This one I think you understand very well, the valuation, the share price, and the ownership stake. Pro rata rights, we spoke about that very quickly, but basically it's your ability to keep the same ownership in the company. So as an angel investor, you might want to allocate some amount of monies to back your winners and to keep the same equity percentage in the future. Liquidation preference, let's talk about this a little bit. And typically what you have is participating or non-participating liquidation preference. So you would have the 1x usually. In some cases, and I think more like private equity investors might have 2x, 3x, but not really in venture. You don't really see that. And then it's either participating or non-participating. The participating means that you get your $1 million back plus your share in remaining proceeds. If an exit happens, you own certain percentage, you get both the $1 million back and a percentage of the total exit. Non-participating means you get either your $1 million back or the share of exit proceeds, so you choose the one that's larger. And if we look at numbers, this is what it would look like. So let's say you have invested $500,000, you own 10% of the company today, and there's an exit at 8 million. So if you have 1x participating, you get both $500,000 back and 10% of the remains of the 8 million. If it's 1x non-participating, then you get either the 500 or 800, so you would choose the 800 in this scenario, right?
And this liquidation preference you can execute at a certain time or at the maturity or
Liquidation event.
At exit.
Liquidation event.
Yes. When a liquidation event happens, this is when you...
And this is exactly why I think sort of like the 1x doesn't make sense, because why would you agree to kind of take your money back if there's a liquidity event?
So usually it's either participating or non-participating. But...
so basically it's at the next round.
no,
Any
this is at...
liquidity event. Any
yeah.
liquidity events.
So for example...
Money is raised, and
Yeah.
you have an option at pro rata rights to keep your shareholding or dilute. If everyone's bought out, then you have a chance to kind of execute your liquidation program.
So yeah, this happens when someone else buys the company, when there is merger. In very unlikely scenario for you, IPO. Like most likely you will have exited much earlier than an IPO happens. And to be honest, we didn't have any too many startups in the Baltics doing IPO. Yeah.
But it means that also there's, say, not very good exit or exit below kind of valuation estimates, then the one who has liquidation preference will get kind of proportionally more than equity holders.
No, liquidation, I know that liquidation, you think that the company is liquidated for some reason, right? That it's not doing well, but
I
this is...
understand it's an exit event.
Yes.
But there could be an exit event at half the price.
Half the price
Half
of the previous.
of the initial valuation, you mean? Theoretically, yes, it can happen.
With liquidation preference, get the whole money back.
Gets everything and Walden gets nothing basically. That's
There was
and
a...
that creates quite a kind of interaction, interesting among the holders of these.
Yeah, so usually the last money in gets first money out, and that's the issue. So later stage funds, they get their money back first, and you as angels, you are the last ones on the list.
It's not necessarily true. Like here's the point which you made earlier. You said like if the founder negotiates hard, he negotiates on behalf of the angels as well.
That's
He
true.
can always say like, you know what, like if I'm doing well, like I can say no to liquidation preference. I can say no to preferred share stack. I can say no to many different things. The problem is like if you are in a position not to say no, then you agree to like 3x liquidation preference, participating, and then sort of the last money in gets like 3x of like 10 million invested plus like 25% of everything. Then like what you get is essentially teeny tiny.
Yeah,
Really
we're
nice one.
really out of
Yeah.
time.
Like it's kind of like
We're just being waited at the next place, and
it's all about the fire alarm. But anyways, you'll get a chance to review it. I tried to make the slides quite comprehensive and
they're
readable.
very readable. They're
Exactly,
very
so
readable.
that was my intention, so that when you get back home and you want to maybe look at it again, you have the chance to do so. I'll just go, and you'll have the key mistakes here that angels also make when doing due diligence, when dealing with founders and co-investors, and with your money in general. So, if you're interested, have a read, but I will not keep you from waiting for the dinner any longer. So, forgot the most important part. So, I wanted to share this opportunity with you because I think you deserve to know. We are raising our next fund to keep doing what we're doing today, to invest into Baltic pre-seed founders, and we're planning to invest in 25 companies in the next 4 years. And we are raising an 18 million fund to do that. We already have 3 million committed by our anchor LP and almost 30% in soft commitments already from other investors. If you're interested, I'm more than happy to share more information on that and tell you what we're doing. I think it's an exciting opportunity to tap into, and you've heard a lot today that investing with a fund, sometimes it's easier because, we have a 7-people team working full-time on finding the best deals and making sure that we exit. Whereas with you, maybe you sometimes want to spend more time on your work, on kids, on whatever. So consider this. And we believe that we really are a VC that these times need. This is us, by the way. All right, well, thank you. Thank you so much.
Yeah, sorry for cutting it short.
No, it's okay. It's the fire alarm, you know.
But okay, I guess we can do another round of applause for the both of the speakers. Yeah. Small goodie bag for you.
Thank you so much. That's so sweet.
And a small goodie
Amazing.
bag for you as well.
Thank you.
Yeah. But yeah, in order for me to also wrap up very fast.
It's heavy.
First of all, thank you for participating in the course. I'm a little bit chaotic in with the way I'm speaking. But what I really want to say is that this is really not the end that we want to have with you. So what we would like to do is that we will be keeping you informed about the ongoing free startup progresses, which is already promised before. But we also want to invite you all to our next regular LatBAN event, which is on 12th of November. Basically, it's a chance for you to kind of attend, see how our monthly events, what they are, what kind of people are coming there. We will actually have a guest speaker, Arne Sozos, who's going to be sharing his interesting business story, as well as one of our members, who is a founder/investor, will be sharing the story how he sold his company today, actually. So it's going to be interesting events. It's a chance for you to kind of see what we do on a monthly basis and kind of get to know the community. And last but not least, as you are now, let's say, pre-qualified angel investors, for you to kind of make the first step in all of that, there's also an offer on the table for all of you to be a part of our community. Basically, it's a chance for you to become official members of LatBAN. What it kind of entails is that you get to see the deal flow of the startups that comes through our organization. Basically, it's mostly Latvian, Estonian, Lithuanian startups. We host monthly official and unofficial events, such as also paddle tournaments or something like that, just to keep it fun. But yeah, essence, being part of the community, being around cool people, meeting hearing new stories, plus kind of broadening your knowledge of different topics as well, because knowledge is key, as we like to say.